We're back. Time for Ask Annex. Head to the website if you got a question, annexwealth.com. Look for the Ask tab. If we can help, you hit the Get Started button. Fred Coleman, CFP and a wealth manager, is with us. Hello, Fred.
Hey, Danny.
Matt Morzy, Director of Research and a CFP at Annex Wealth Management, part of the investment team. Hello.
Hey, Danny.
Here we go. My 22-year-old granddaughter stumped me over the holidays. I'm impressed that she has over $1,000 available per month to invest after expenses. But when she asked what percentage to put toward retirement and how much should go to her shorter-term investment, I wasn't sure. I like the show and hope you can help.
Thanks for listening to the show. You know, when I think back at 22, time is your best friend, and it's one of those things you can't get back. So she's really in like the golden age where she has the time to take advantage of a lot of compounding interest. So in her 20s, because she's in her 20s, most of the money I would put towards investing, just focusing on investing as much as possible, because that'll really minimize some of the work that you have to do when you get older. It's going to be much harder to catch up when you're older compared to if you start early. I wouldn't focus too much on the short-term goals unless she has those goals defined. When it comes to balancing, short-term versus long-term, short-term, those are going to be anything in the next, 0 to 5 years. So if she does have those defined goals, and you could put a little bit more towards those, whether that's, buying a car, going on vacation, down payment for a house, those types of things, and you want to keep those in shorter term instruments, like cash, money markets, maybe some safer investments. But anything past that, so when we start talking about retirement, the long-term goals, you really want to put as much towards that as possible. So those long-term investments, she can be, really aggressive with those. So depending on her situation, I would say at least 50-50, between short and long-term goals. But if you could lean towards, maybe putting 800 of that 1,000 in long-term and 200 in short-term, that's the route that I would go.
Yeah, I think that's great. And just from a compounding standpoint that you mentioned earlier, Fred, I was taking a look at this online. There's a lot of different calculators you can look at and stories that, talk about the time value of money and how much that impacts. So I found this one. So the person's a little bit younger, but pretty close. So if you invested $2,000 a year starting from age 19 up to 27, so 8 years in total, but then stopped putting money into the market and just let it grow. Assume you're an aggressive all-stock investor and you got the 10% per year that we've historically gotten in the U.S. stock markets. By the time you turn 65, you're going to have $1 million. So you invest for 8 years, $2,000 a year. You're 65, you have $1 million. So she has more than what would be $166 a month extra that she could put towards this, but that's pretty amazing. Mm-hmm. Now, just to contrast that to the impact if she waited and used this to just fund short-term things or buy a house or buy those bigger things right away. If you waited to that age 27 and still put the $2,000 a year into it, but did it all the way till you're 65, so 27 to 65, putting that in, you'd only have $800,000. So just by all that extra time to compound and getting that into the stock market early is such a huge impact on people that are young. It's somewhat unbelievable. So she's got a lot of wiggle room, making sure that there's no debt and paying that stuff down, but trying to get as much money into the market as she possibly can is going to be tremendous for her.
It's Ask Annex. Next question. I'm attempting to interest my grandchildren in investing. They want to invest in companies they like and use. But in my research, the fundamentals look terrible. How do I balance teaching them basics but not crushing their curiosity? Because they would take a bath on some of these companies.
I can see the dynamic there of trying to help them out, get them interested, but at the same time making sure they're doing the right thing or that you're not going to squash that interest. But frankly, I think that actually might be the best possible outcome. When you're younger and the dollar amounts are much smaller, taking a loss at that point in time is not going to impact you as much financially as it would later on in life when you're using larger dollar amounts. But it also is going to teach valuable lessons of the companies that you're investing in and how you're doing it and what works and what doesn't work. I actually think that's the best thing possible. And in fact, like during COVID, the market was getting hammered, but people, because they were stuck inside their houses, so many people were going out and opening up brokerage accounts and investing right away because they couldn't gamble on sports. They couldn't go out to go shopping. They couldn't go out to dinner and doing that. And, one of the things that they talked about on CNBC a lot is, well, what if this all comes crashing down? All these stocks that are up a ton, what if they pull back? Is that going to stop all these people from investing? And what we've seen since then is actually the risk tolerance of people who are younger right now is much higher than previous generations because they saw that big crash down. They survived it. but kept going, and they saw the market rebound afterwards. Now, we've had quite the run since that COVID low. And we did have that big pullback in 2022, but we've had some good markets since then. So it rewarded people who were taking that risk. But taking those losses right away, realizing, hey, just because I buy this type of shoe or I buy this kind of shirt or I go to this place does not mean that it's a well-run company that has good fundamentals and is going to increase its stock price over time or pay dividends. Investing just because you use it is not going to be that fundamental reason. There's a lot of different ways you could explain that too. I mean, you think, we're in NFL playoff season right now. There's a lot of teams that might be your favorite team, but they might be terribly run and they're sitting at home right now and they're not still playing. So you think, I really like them. I want to support them. But, if they're not well run, just like a company that's not well run, that stock price is going to go down.
Matt Morzy, Director of Research, CFP, thanks.
Thank you.
Fred Coleman, CFP, Wealth Manager, Annex Wealth Management, thank you.
Thanks, Danny.